Everything you have learned regarding support and resistance is not entirely accurate. Breakouts don't always succeed. Stop losses are often targeted. Ideal setups can reverse immediately. Many traders attribute this to bad luck. However, this is not the case. It's a matter of liquidity. In this video, I'll explain how institutions genuinely influence the market using straightforward language, devoid of complex terminology, unnecessary establishments, and repetitive theories. By the conclusion of this video, your perspective on charts will be permanently altered. Allow me to pose a question. Have you ever participated in a breakout only to see the price surge, trigger your stop loss, and then proceed precisely in the direction you anticipated? This occurrence is not coincidental. This is a matter of liquidity being absorbed. Retail traders are conditioned to purchase breakouts and liquidate breakdowns. Institutions require those orders. This necessity arises because they can't initiate substantial positions without corresponding liquidity. Thus, prior to the actual movement taking place, they gather orders. This is the nature of the market. Before surpassing liquidity, it's essential to establish structure. The concept of market structure is straightforward. Uptrend equals higher highs and higher lows. Downtrend equals lower lows and lower highs. However, this is where the majority of traders cease their analysis. Intelligent money traders seek a more profound understanding. Breakup structure: when the price surpasses a previous swing high or low, it indicates a shift in momentum. Structure provides insight into direction. Liquidity offers guidance on timing. Make a note of this. Structure tells the direction. Liquidity tells the timing. Liquidity essentially refers to the location of resting orders. Where do retail traders position their stop loss orders? Above equal highs, below equal lows, above clear resistance levels, below clear support levels. Now consider this logically. If institutions aim to sell significantly, they require buyers. Where these buyers be found? Above breakout points. What occurs next? The price rises slightly above equal highs. Breakout traders enter the market. Short sellers are forced to close their positions. Liquidity is gathered. Subsequently, the actual movement commences. That spike you refer to as manipulation is in fact the collection of orders. Price shifts to areas where orders are present. This is always the case. Let us discuss a highly significant concept: liquidity sweep. This occurs when the price intentionally moves past a critical level, only to reverse. This constitutes the trap. For instance, equal highs are established. Retail traders identify resistance. They position their stops just above it. The price spikes above. Stops are triggered. Breakout traders initiate long positions. Then the price plummets. Why does this happen? Because institutions have just executed their sell positions. The same principle applies in the opposite direction at equal lows. If you begin to anticipate the sweep rather than pursuing the breakout, your success rate increases significantly. However, here is the crucial point. You do not enter merely because a sweep occurs. You await confirmation. Let's deep dive a high impactful concept: liquidity sweep. Here's a straightforward 5-step framework. Step 1. Identify the trend using structure. Step 2. Highlight clear liquidity, equal highs or lows. Step 3. Wait for the sweep to occur. Step 4. Observe for structure shift on a lower time frame. Step 5. Enter with a clear defined risk. Your stop loss should be placed beyond the sweep, not too tight, not arbitrary. It should be logical. Additionally, your minimum risk to reward ratio should be 1 into 2. If it's not at least 1 into 2, then skip the trade. Discipline is more important than frequency. Smart money concepts devoid of risk management is merely gambling. You should never risk more than 1 to 2% on each trade. Avoid revenge trading. Do not increase your lot size following a loss. Professionals consider probabilities, not emotions. A single loss signifies nothing. 5 consecutive losses still acceptable if your model is statistically valid. Your responsibility is not to win every trade. Your responsibility is to execute flawlessly. That is all. The most challenging aspect is not recognizing liquidity. It is the act of waiting. The majority of traders fail due to the following reasons. They rely on anticipation rather than the confirmation. They engage in excessive trading. They pursue price movements impulsively. Successful liquidity trading demands a high level of patience. At times, the optimal decision is to refrain from trading altogether. In the absence of a distinct market sweep, you remain seated. Professionals are compensated for their patience. Amateurs receive compensation for their activity. Let us summarize clearly. Structure provides guidance. Liquidity determines timing. Be patient for the sweep. Await confirmation. Minimize risk. Aim for a minimum of 2 hours. This constitutes the framework. No indicators are necessary. Only pure price action and discipline. If you genuinely grasp this concept and implement it correctly, you will cease to feel as though the market is working against you. It is not against you. You were merely trading at an inappropriate time. If you are committed to mastering structured execution rather than relying on guesswork, and you seek more in-depth analysis with actual chart illustrations, please comment liquidity below. I review every serious comment. And if you found this information valuable, please like the video so that more traders can stop contributing to the market. Trade wisely, trade with patience, and keep in mind, price moves to where orders are present. I look forward to seeing you in the next one.